All right, let's go over fixed assets first. We have a server, we have a truck, we have some furniture on our books and records. And we're going to have an accounting or fixed asset accounting policy that's going to give us some guidelines on what the useful life or useful lives should be of these assets. And then we're going to take that, we're going to take our cost basis, what we paid for those assets, and we're going to straight line depreciate those assets over their useful life. Based upon the straight line depreciation, we are going to recognize our annual depreciation related to those fixed assets. Intangible assets. Let's take a hard look at this because it's going to be a little different than fixed assets. You might not have an intangible asset policy, much like you would have a fixed asset policy. These are going to be more looked at when you buy the intangible or create the intangible and how long that useful life is. In this example, we have a book of business that we bought from another business. We have customers that we've brought in-house. And in this example, this book of business, we determined that its value or what we purchased it for was $500,000. The useful life related to an intangible asset going to be a little bit more subjective. You're going to look at your past experience with buying intangibles or creating intangibles. You're going to look at market data and just what it is. Do you think it's going to last X amount of years? In our example, we think our customer book of business is going to last 20 years. So in this instance, we're going to take our cost, our purchase of the book of business, and it's going to be a straight line amortization. We're going to take our $500,000 cost basis, divide it by 20, and we're going to recognize $25,000 of amortization each year. So let's layer that into our GAAP financials. Now, switching over to tax, you're going to run into a very different scenario. In this example, we're going to assume the fixed assets that we have purchased are eligible for Section 179. And Section 179, if you're not familiar with that, that gives you the ability from a tax basis to take the full cost or the expense of that fixed asset in the year that you purchased it. Unlike the GAAP basis accounting, where you are taking a straight line depreciation approach, Section 179, we're going to take the full expense related to those fixed assets, as long as it's eligible for Section 179, in the year that we purchased. Now, amortization related to an intangible asset have a certain set of rules. If you're buying a book of business like we are in this scenario, you do not get to choose your useful life. It is 15 years. That has been provided by the IRS. So that $500,000, even if I think it's going to last 20 years or 30 years, the IRS says, hey, it's a 15-year asset. Take your $500,000 book of business that you bought, divide it by 15. That is your expense each year for that book of business. So let's layer that in. So you'll say we have a pretty large difference between our GAAP basis financials and our tax basis financials. Net income on a GAAP basis, $256,250. On a tax basis, especially since we can take that Section 179, we're ending up with taxable income of $184,167. So you can see from a GAAP to tax standpoint, depreciation and amortization can have major differences between the two sets of accounting methodologies.